But here's the book. These are all things we have. I'm going to read a few of the samples, but look at this. These are all, each line is something that we did. Nobody did that before. And it's big stuff, too. Look, we have the hottest country in the world. So I will read you a few. We ended Biden's stagflation. We were in stagflation. That's a disaster. That's far worse than inflation. As you know, he had the biggest inflation in the history of our country. They say 48 years. Pick your choice. But they had the biggest inflation in the history of our country. We have it right down to a normal number now. We're going to get it even a little bit lower. Created super high. What we've done with growth is incredible. We created super high economic growth. And America is booming. It's booming. There are thousands of businesses right now that are being built. Many of the biggest factories in the world are being built right in our country. They're not going to other countries. They're leaving other countries. Fourth quarter GDP is on track to pass perhaps much more than 5% growth, and that's despite the fact that we had a Democrat shutdown. They shut down our country, and we had 5%. Nobody in this room has ever heard about 5%. I think it could be 20%. If we do it right. If we don't, every time we have good numbers, they raise interest rates. You shouldn't do it. In the old days, if you had good numbers, they'd lower interest rates, or they wouldn't do anything. Here, they try and kill it. They always try and kill success. Over the last 20, 25 years, that's the way. In the old days, if you had good numbers, the market would go through the roof. Today, if you have good numbers, the market goes down. But by the way, we've had the best stock market in history, the best 401ks in history. And we inherited a mess. The numbers that we inherited were way up, and now we brought them, almost all of them, way down. We brought them way down. I mean, I'm not getting, maybe I have the bad public relations people, but we're not getting it across. We inherited high numbers, and we brought them way down. And look at gasoline. They have places in the country now, $1.99 a gallon. $1.99, $2.30, $2.50. I guess the average now they're saying is $2.31. I mean, he was at $4.50 and $5 for periods of time. And he went back to the Trump formula, but he didn't do it properly, and he really went back to parts of it because you would have had $8 gasoline if they didn't. But he didn't do it properly. He had people that didn't know what they were doing. Core inflation for the last 3 months is 1.6%. 1.6. Their core inflation was so high that nobody could even calculate it. Under Biden, real incomes declined $3,000. Think of that, $3,000. That's a year. In 12 months, Trump real incomes went up by $2,000 and $3,000 and even in some cases $5,000. It's a tremendous difference. Stock market has set 52 all-time record highs during the course of the 11 months, because this was done on 11 months. Now we are actually officially 12 months as of today. 52 all-time record highs. That means 401ks did great. I have people see me all the time, policemen that guard us really well, and got to know them a little bit. And they said, "Sir, you're making me look so good. My 401ks through the roof. My wife thinks I'm the greatest genius, that I'm a financial genius, like Warren Buffett." He told me that. He said, I think they have better returns than Warren Buffett right now. But he said, all my life, my wife has been criticizing me for not being smart financially. Now, all of a sudden, she loves me more. But we added $9 trillion in value to retirement accounts, saving many people. I mean, they were going out of business. Think of it. We added $9 trillion.
All right, everybody, you are listening to President Trump there at the White House, getting ready shortly to head off to Davos, Switzerland. He is making a speech there this morning. In the meantime, we're going to continue monitoring that and look for some headlines. Welcome to Bloomberg Businessweek Daily. It's a pretty busy Tuesday, as I had to be reminded, not Monday. We did have that long weekend, although it feels like a week already has happened. I'm Carol Massar, along with Tim Stenovec, live here at Bloomberg headquarters in New York City. We've got a lot going on including a lot of headlines coming out of Davos. We're going to talk about the markets. We're going to talk about what happened in the Japan bond market overnight. Also some concerns about U.S. Treasuries. Bob Michael of JPMorgan Asset Management is going to join us in just a moment.
Also, President Trump's Fed chair search becoming a hunt for an elusive unicorn. Remember, we were supposed to hear about this before the Christmas holiday, before
Correct.
the end of the year. Former Fed President Robert Kaplan. We'll hear from him a little bit later.
Yeah, we're going to get into that. All right, folks, let's get a check on the trade because we are seeing really kind of the backing off on the U.S. trade. We're certainly seeing that play out. We've got stocks pretty much near their lows of the session. Let's head on over to Charlie Pellet. Quick check on the trade on this Tuesday.
Hey, thank you very much, Carol and Tim. With the Dow, the S&P, NASDAQ deeply in the red. Keep it locked into Bloomberg Radio and Television for the latest on these markets right now. The S&P down 128 to 68.11. That is a drop right now of 1.8%. As Carol mentioned, very close to session lows. The Dow down 824 points, a decline of 1.7%, while NASDAQ is down 479, a drop there of 2%. The Bloomberg Mag 7 index down 2.7% with the 10-year 4.28%, the 2-year 3.58%, and the 30-year 4.91%. Gold up $87 the ounce, surging to a record $47.58, up 1.9%. Silver now up 0.1%, $94.50 the ounce. West Texas Intermediate crude up 1.5%, $60.30, and Bitcoin now down by 3.5%, 89,648. After the bell, we'll hear from Netflix. Netflix up 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, so appreciate that. We're going to keep a watch on the markets for you, as well as watching the president there at the White House holding a press conference. We should point out one headline that did cross the Bloomberg in regards to what the president's saying at that White House press briefing, that oil firms are preparing what he said are massive investments in Venezuela. So that's certainly following up on the recent meeting there at the White House.
Yeah, the president said, quote, "I'm loving Venezuela. They've been working with us as well." And he did appear also in the press conference, which is ongoing. You can see it if you're watching us right now on the side of the screen. He appeared to praise Machado, suggesting keeping her involved. We'll bring you additional headlines and then, of course, go to the Q&A when it does happen with reporters.
Bunch of reporters there in the room. All right, in the meantime, one of the focuses, certainly for the Bloomberg audience, investors, leaders around the world, the World Economic Forum, their annual meeting in Davos, Switzerland is underway. Our live blog keeping track of it, the highlights of the narratives. For today, that meant really the domination of President Trump's fight for Greenland in conversations already on the ground. There also French President Macron saying the EU should not hesitate to use its anti-coercion tool. This is an official thing. And Japan's finance chief calling for market calm after the country's sovereign bonds sold off. I got to say, it's impossible to highlight all the voices that are saying things on the ground in Davos, or all that President Trump is currently saying and putting out on social. But it is fair to say that the world's citizens and investors and leaders are wondering what from President Trump sticks in terms of policy and ultimately ends up impacting everything. On that, we want to give you some of the highlights, some of the commentary from President Trump over the last 24 hours. You're going to hear from the president, followed by Treasury Secretary Scott Bessent, the U.S. Trade Representative Jameson Greer, Rachel Reeves, the UK Chancellor of the Exchequer, and Paul Ryan, former House Speaker. First up, though, here's President Trump.
Let's put it this way. It's going to be a very interesting Davos.
This is the same kind of hysteria that we heard on April 2nd. There was a panic. And what I'm urging everyone here to do is sit back, take a deep breath, and let things play out.
The president clearly has decided he doesn't want to impose full sanctions on countries all the time, but he can use a lesser measure like tariffs.
All of our focus is on de-escalation, not in worst-case scenarios.
It bothers me when I hear companies feel they need to diversify away from America because of the uncertainty. But if we get this uncertainty dealt with, if the uncertainty tamps down, then I think we'll be back in business.
Well, I think I have a lot of messages for Davos, but the primary message is how well the United States is doing.
Well, there you have it. President Trump, followed by Treasury Secretary Scott Bessent, U.S. Trade Representative Jameson Greer, Rachel Reeves, UK Chancellor of the Exchequer, Paul Ryan, former House Speaker. Great to have back with us on all this and more, Bob Michael. He's Chief Investment Officer and Head of Global Fixed Income, Currency, and Commodities at JPMorgan Asset Management, also co-chair of the Asset Management Investment Committee, a member of the Asset and Wealth Management Operating Committee and the Asset Management Operating Committee.
He's kind of an important dude
in the studio. Perfect day to have you, whether we're talking about Japan, whether we're talking about what's going on in Europe. I kind of want to start with the president's latest assaults on European allies and market reaction that we are seeing. Is the talk actually turning into something that our allies are concerned about?
I think so. It feels very chaotic again. So Besant is right to refer back to April of last year when there was a panic. I know last night I went to bed in a panic and woke up in one, and it didn't get any better.
Because of Japan?
Well, because of so many things. We thought the president was going to Davos to talk about housing and credit card affordability. Suddenly now it's become about Greenland affordability. How are we going to buy or take it? And how are the European countries going to finance us? Are we going to re-tariff them? And it seems crazy, except that things have a way of happening which people didn't think would happen. So you have to back away and de-risk a bit. Japan, I don't know if that necessarily came out of the blue, but we're now faced with that, where the bond markets become unanchored because there are going to be snap elections and everyone's going to compete for fiscal stimulus. If we're looking at the bond markets and assessing all of these things, it feels that the fiscal austerity, which everyone embraced after the great financial crisis, is out the window. It's now borrow and spend. There seems to be plenty of capital around to finance it, and a backup in yields may not be so bad. So yeah, things are a bit chaotic, and the markets do feel a bit panicked.
So Bob, there's chaos, there's chaotic moves, there's de-risking, and then there's de-risking. So is this like a short-term think until we really figure out how much of what the president is saying is just rhetoric or the first negotiating ploy, or something that sticks around longer and impacts the investment landscape longer?
It's hard to know. I would have liked to have heard something at 1 o'clock. Instead, it's sounding like a domestic victory lap, then board Air Force One and head to Davos and deal with a whole international array of problems. And my guess is the administration is going to put everyone on their heels and negotiate the best deal, whether it's Greenland, whether it's Venezuela, whether it's tariffs, whether it's with China. Who knows?
Should the president be taking a victory lap based on what you've seen in the past year?
If I'm purely objective and sit here in January and say we're heading into 2026 with some momentum. We closed out the fourth quarter pretty strong. We're expecting somewhere either side of 2.5% for GDP and inflation in the U.S. The U.S. is collecting some tariffs. The effective rate's about 16%, so that's a source of revenue. The markets are at highs, and that momentum looks like it's going to continue. So, yeah, I think you can claim that if you want to.
A chance, though, that the bond market and perhaps even the equity market are overreacting. The president, for much of last year, there was the taco trade, the idea that what the president said wasn't necessarily what ended up happening. And I think the so-called Liberation Day tariffs are a perfect example of that.
We're entitled to overreact. I think we've been pretty well behaved for a while. Volatility metrics have been abnormally low. We're allowed to throw our toys out of the pram every so often. I think this is a message from market participants to the administration. We can only go so far, and they've got to figure out where the line is. I think what Besant forgot to include was, the market had a fit in April, and then they backed off of a lot of things, and then calm ensued. We need to hear some of the same kinds of things.
We should note the president is still making comments at the press conference. We'll go back to it when he does take questions from the press. You can see it right there on the screen. Also check it out on LiveGo on the Bloomberg terminal. You mentioned the reaction back in April. I believe the technical term the president used was the bond market got a bit yippy. Is the bond market yippy now?
Not yet. if you look at Japan, Japan has a whole host of domestic things to deal with. So that's become unanchored. When I look at the U.S. market, yeah, we backed up a little bit. But you know what? We've got a Fed funds rate at about 3 5/8. The 2 years within touching distance of that. You've got somewhat of a normal steepness to the yield curve from Fed funds to 2s to the 10-year and the 30-year. It all feels pretty orderly now, a bit of a pause. So I actually think things feel okay.
Anytime I feel like, Bob, we pull up geopolitics and people are like, well, who holds U.S. treasuries? And we've got a story on the Bloomberg that talks about European countries holding trillions of dollars of U.S. bonds and stocks, some of which sit with public sector funds. And so there's, the speculation that could our allies or even folks like China or something like sell U.S. debt. Is there really any alternative into U.S. debt realistically?
No, there is not. And we did this about a year ago. We went through this in March, April, May. We spent a lot of time talking to our clients, particularly our non-U.S. clients. They looked at everything and came back to, when you look at the U.S. debt markets, which includes governments, but it's corporates, it's securitized, no other markets have the depth and the breadth. They have confidence in the country. They're not willing to abandon it. They see the presidency as two-year terms when you throw in the midterm elections, so they're willing to ride through it. I don't think there will be wholesale selling of U.S. Treasury debt.
So you're referring to the Danish pension fund, academic or pension to exit U.S. Treasuries.
And that's a small, but I just, in general, like I think about, we've talked about it in terms of China or just any, that this is a great lever that foreign investors or foreign governments could pull against the U.S. But the reality is they're not likely to, because there kind of is no alternative.
We had a lot of very large non-U.S. clients look at alternatives and line up plans. If we were to sell this, this is where we would go. And they paused putting more money into U.S. bonds, but they didn't take any out. And by the end of the summer, they were putting money back in again.
We're speaking with Bob Michele, Chief Investment Officer and Head of the Global Fixed Income, Currency, and Commodities Group for JPMorgan Asset Management. The president's still speaking at the White House. We do expect him to take questions too in just a little while. Back to this pension, because Anders Schelde cited, this is the fund's Chief Investment Officer, cited Trump's talk of taking over Greenland, concerns about fiscal discipline and a weaker dollar for reasons for the decision. You don't buy the fiscal discipline and the weaker dollar part of this. You think this is just political?
Where is there fiscal discipline now? It's hard to find it. Like, go to the old stalwarts. Germany, not there. Look at what Japan could and couldn't do. That seems to have been abandoned now. The U.S., for sure, we'll see who the next Fed chair is, but it sure ain't going to be the next Paul Volcker walking in. So I think fiscal discipline is a thing of the past, and there is a feeling that deficits can be financed, and Japan is kind of telling us you can get to 300% and life's still good.
So when do we pay the piper on this global lack of fiscal discipline? I think about Andrew Ross Sorkin, who was just on to talk about his book 1929, and we talked about crises in particular or in general, and that leverage and debt, right? These are the things that get us into trouble, whether we're an individual, a company, or a country, or can. So is that potentially the next crisis, just the lack of fiscal discipline globally, or do we just kind of continue to go along here?
So I read 1929. It was very engrossing. I don't see the problems that existed then here today. I don't see the rampant leverage throughout the system, which is becoming problematic. It can't be served as. It's being written down.
Even on a government or sovereign level.
Yeah, it's not happening at the government or sovereign level.
And
that new tool called QE allows that to perpetuate.
Right. Well, that's the point. Like, I think about years ago, I remember not doing an interview, a business news interview or markets interview, without talking up about the U.S. government debt. And then it went away. And now we are back again. So, I think we kind of continue to try and find out, when is it really a problem. Certainly as rates go higher, it becomes more expensive to service, certainly here in the U.S. But I'm just wondering, like, when...
I think when it gets thrown away, I started in the business in 81. I worked through the twin deficits. I was taught the U.S. will never be allowed to finance itself below 10% again. And we promptly dropped from 16% to 0.3%. And in the Clinton era, suddenly, the deficit was gone. We look at where the money is being spent, and we may not always agree where it's being spent, but it does create some productivity. We talk to all the municipalities that are accessing the various programs they can. They're actually going in, taking capital, they're hiring people, they're consuming resources, and they're investing in their townships or their states or their cities or whatever it can be. Ultimately, that generates activity that gets taxed. And I think that's what we saw in the late 80s into the early 90s.
Last question, I'm going to make you push ahead to our conversation with Robert Kaplan, Vice Chair at Goldman, and we're going to be hearing from him in just a few minutes on the Fed. Polymarket has Kevin Warsh as the favorite for the nomination. In fact, Rick Rieder is now number 2, which is interesting to see. Who has the bond market priced in as the next Fed chair?
I don't think the bond market has a great idea. Rieder's number 2 for me. I've known him for close to 40 years. I think he'd be an excellent Fed chair. I think he'd be somebody very different. Let's get a true bond markets practitioner in there who's had to live with the aftermath of Fed decisions. So I'm certainly a supporter of his, but he's number 2 behind Bessent is still my number 1. I think the president is still stalling and trying to negotiate with Bessent. I don't see Warsh too hawkish. Hassett's got to be removed because of the DOJ. And Waller, I don't know that the administration feels they can control Waller. Rick is the, shining knight that comes in out of left field. Smart guy will do the right thing, but I still think it's Bessent is number 1.
Was not expecting to hear that.
So right thing, whether it's Bessent or Rieder or whomever, will be independent, or that depends?
I've never fully believed that they're independent because they're political appointees. So they get appointed for their core views. I believe when they're in office that they always try to do the best thing. But some believe that fiscal austerity is the best policy, and other believes that a lower cost of funding and economic activity and monetarism will help stimulate the economy.
That discussion around the table, right, means something, right? And all
It
those
does.
different voices. Your voice always means a lot to us. Thank you so much. Really
Happy to
appreciate
be here. Great day for it.
Yeah, exactly. We thought that on our planning call. We're so glad he's here today. Bob Michael, be well. We really appreciate it. Chief Investment Officer, Head of Global Fixed Income, Currency, and Commodities over at JPMorgan Asset Management. All right, coming up next, folks, we are going to hear from Bob Kaplan. He did sit down with our own Julie Fine, so see what he has to say about what he thinks might be the possible, or who might be the possible head of the Fed, and kind of what goes in the room where it all happens.
In the meantime, let's send things on over to Charlie Pellet in the Bloomberg Businessweek studio, because stocks moving lower, Charlie.
Indeed, Tim, holding just above 6,800 right now. Going to be very interesting to see if we dip below that big round number. Right now, the S&P at 6,801. We are at the lows of the day, trading down by 2% right now. Renewed geopolitical tensions with Europe driving the S&P 500 lower. And by the way, it has erased its 2026 gain. The Dow right now down 875 points, a drop there of 1.8%. We've got NASDAQ, the composite index, down 528 on NASDAQ, looking at a loss right now of 2.2%. The NASDAQ 100 index down 2%, and the Russell 2000 index of small cap shares down 1.1%. The Bloomberg Mag 7 index down 2.9%, with a 10-year at 4.28%, the 2-year 3.58%, and the 30-year 4.91%. Gold up $91 the ounce at $47.62. Right now, we do have silver trading higher by 0.2%. Silver and gold both at records, $94.63 right now on silver. West Texas Intermediate crude up 1.5%. WTI $60.47 a barrel, and Bitcoin right now down $3,500 a token, down 3.8%, $89,445 on Bitcoin. Goldman Sachs Group and Qatar Investment Authority have agreed to expand their strategic partnership. Goldman Sachs shares today down by 2%. Bank earnings, U.S. Bancorp after earnings is trading lower right now. We've got U.S. Bancorp down 0.7%. Fifth Third after earnings up 0.9%. KeyCorp after earnings down 1.6%. After the bell, Netflix ahead of earnings. Netflix up under 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stenovec live here at Bloomberg headquarters in New York City. Hey, among the most read stories on the Bloomberg, President Trump's search for a new Fed chair who is a loyalist, commands credibility with Wall Street and his MAGA base, and has a shot at Senate confirmation. That short list, we just were talking about it with Bob Michele over at JPMorgan Asset Management, talking about Kevin Hassett, potentially National Economic Council Director for the President, BlackRock executive Rick Rieder, current Fed Governor Chris Waller, and then former Governor Ken Warsh. All have, though, potential weaknesses, at least according to our reporting and how we're reporting it out.
As we just heard from Bob Michele, he thinks the number one would be Scott Bessent, the Treasury Secretary.
Which is interesting.
I was shocked to hear that. I mean, those odds on Polymarket are 1% for him. So
the only thing I think is interesting is I feel like the Secretary of the Treasury has been very quiet lately. I mean, I know we've got a story in the terminal, but he's been very quiet as of late, and I just thought that was interesting. There's a lot going on. Someone who knows about being a member of the Fed, Robert Kaplan, former president of the Dallas Fed, now vice chairman at Goldman Sachs Group. He caught up earlier today with Bloomberg News Texas Bureau Chief Julie Fine. And Mr. Kaplan weighing in on the next possible head of the Fed and also taking us inside the room, the Federal Reserve, where it all happens.
The culture inside the Fed is people have different views, they have different political backgrounds, but when they get in the room, they argue based on what they truly believe and they debate it out. I'm hopeful that culture will stay alive. I think the new Fed chair, though, is likely to want the Fed to anticipate inflation improvement, where this Fed feels like it wants to further lower rates from here based on a demonstrated improvement. So there'll be that tension. But is it possible? Yes, it's possible. But it will put the onus on the next Fed chair to demonstrate it.
We've heard the names Kevin Hassett, Kevin Warsh. Now, Rick Rieder's star seems to be on the rise. Who do you think would be the next Fed chair, and who would be the best one?
Well, obviously, I don't know who it's going to be, and I think any of the names mentioned could do it. Each of them come from a different place. If they're from outside the Fed, they'll have to learn about the Fed and understand the Fed, and that will affect their views. If they've got a history of the Fed, that's another background. If they come directly from the administration, any of them could do it. But I will tell you where they all need to get to is without political pressure or political influence or intimidation, do they congeal the group around a consensus without regard to those outside factors? That's the challenge.
And now all of this happens right before next week's meeting. I mean, what do you think comes of that?
Well, so for the meeting, the Fed cut 0.75% in the fall. Okay. It did that because it was worried about weakness in the labor market. Okay. Rightly or wrongly, there had been a shutdown. There was weakness in labor. They bought 0.75 points of insurance. And the reason that was very tense was they did it even though inflation is still 2.75%, i.e. above target. They're now, in my view, at about neutral. Okay, what's neutral? 0.75% to 1% real. Add the inflation rate. The neutral nominal rate is about 3.5%, 3.75%. And from here, again, they need to see evidence of improvement. And so I thought it was very unlikely they were going to move in January. It's still unlikely they're going to move in January.
All right, that, of course, is Robert Kaplan, former president of the Dallas Fed, now vice chairman over at Goldman Sachs Group, there with Bloomberg News Dallas Bureau, Texas Bureau Chief Julie Fine. Julie's going to join us now. Julie, great voice to talk about the Fed. For the Bloomberg audience, what stood out for you in your conversation with Robert Kaplan?
What stood out to me is I directly asked him, can this person be independent? And he said, yes, this person can. I found that to be very interesting. Then he went into several caveats, as you heard there. That definitely stuck out to me the most. He thinks that, and you heard him say, they get in the room, they really fight it out. But I think he does think at the end of the day, this person can be independent. I think there's a lot of pressure on who's going to be the next Fed chair to actually do what he or she thinks is the right thing to do.
Well, speaking of pressure, a week ago today, we'd be talking about that last Sunday night video from Fed Chair Jay Powell. And, the words unprecedented and sort of shocking, I think, were thrown around quite a bit. Robert Kaplan doesn't necessarily think that's going to be sort of the lasting effect of this Fed chair.
Absolutely. He said 3 weeks from now, that will not be the story, because that was the first question I asked him, because I, like you, were probably very surprised when you haven't heard Jerome Powell really respond to anything that the president has said. I mean, all of a sudden he's on camera. He's right out there. So I asked Rob Kaplan about that immediately, and he basically said in 3 weeks, that's not going to be the story. The story will probably be what happens next.
Man, is there a question you wish you could have had more time to like after hearing this and being like, well, wait, one more thing?
After you always go back and you look at your interview and say, I should have asked this, I should have asked that. I think I should have asked again, really, independence, what does that look like looking back?
Yeah, it's interesting, right? I feel like it's the question anytime we talk about the Fed. Julie, great stuff. Glad we could get some time with you as well. If you missed any of that conversation, by the way, head to the Bloomberg or Bloomberg.com for Julie's full conversation with Rob Kaplan, vice chairman of the Goldman Sachs Group, and of course, former president of the Dallas Fed. Julie, thank you so much. Really appreciate it.
Let's stay on all things Fed and bring in our trusted voice on the Fed, the global economy, the factors that may impact it. Here in the studios, Bloomberg TV and Radio international economics and policy correspondent Michael McKee. What I want to start with is my head's still spinning a little bit from hearing Michael say that he thinks Scott Bessent is going to be the next Fed chair. Well, that's shocking.
It's not shocking. It might be surprising, but not shocking, because we're talking about Donald Trump. So nothing is shocking with Donald Trump. It's certainly possible, and he's mused about having Bessent do it a couple of times. He's clearly not been able to settle on somebody, or we would have had a nominee already. We're 10 days out from when Stephen Myron's term technically ends, even though he can stay on. So maybe there's the wish fulfillment there, but you can't really rule anything in or out.
Well,
go ahead, Carol.
Well, I was going to say our story on the Bloomberg about, President Trump's Fed chair search is becoming a hunt for an elusive unicorn, or Josh Wingrove, Saleha Mohsin, and Josh Green putting this out and saying, he wants a loyalist who will pursue steep interest rate cuts, commands credibility both with Wall Street and the president's MAGA base, has a shot at Senate confirmation, all with a telegenic central casting factor that the president sinks. Is that impossible to find?
That's impossible to find. It's like the Triffin Trenaman and currencies. You can't have all three. You can have maybe two out of the three. He can get a loyalist, he can get a MAGA person, he can get somebody who is going to advocate for lower interest rates, but he's not going to find that person has much credibility on Wall Street. And so the problem for him is, where does he come down? What's the most important thing? And
is independence certainly...
Independence obviously doesn't mean anything to the administration. It means a lot to the Fed. And what you'll end up with is, even if somebody comes in advocating for lower interest rates, the rest of the Open Market Committee is going to push back. Unless there's an economic case for it, he's not going to get it. So he's probably better off if he would go with the loyalist MAGA type instead of the low interest rate guy, but I'm not sure. I have no idea what he's going to do.
But does that person, and again, asking you to look in your crystal ball here, but based on what we heard from Senator Tom Tillis of North Carolina last week, does the person who he picks have any chance of getting through the Senate if there's still an active probe from the Justice Department into Fed Chair Jay Powell?
Well, you'd say no, except that the Republican members of Congress, the Senate, and the House roll over regularly for the president. So
even if they say we're not going to roll over this time.
Certainly, it's possible they change their mind somehow. The president says something, does something, and gets them to change their mind. And Susan Collins is the good example of that happening all the time. So the names that have been mentioned, put it that way, the 4 names who are supposedly finalists plus throw in Scott Bessent, all of them could probably get confirmed, certainly in a Republican Senate. Now, if he picks somebody out of the blue, we don't know. Mm-hmm. It's more a question of, is the Senate and members of the Senate Banking Committee, are they actually going to stand up and say this much but no more? You can't go farther than this.
Does it? It certainly matters who's chair of the Federal Reserve. You keep reminding us that there are certain Fed voices, certainly the chair. They're all important, but there are some that are more important than others. Having said that, if Jay Powell, who can stay on the board, right, for 2 more years, sticks around, is he still then a very important voice when it comes to monetary policy?
Well, he would be a very important voice for 2 reasons. One, because he's led the Fed and he's been the guy who's pulled together the consensus for now 8 years. Mm-hmm. Also because the markets would look to him. And that's something that Powell's going to have to think about in terms of whether he wants to stay on or not, because you heard all the talk, Scott Bessent talking about a shadow Fed chair. Well, you might have one on the other side. It doesn't matter what new chairman says, because the markets are looking to old chairman. And if old chairman says, I don't think so, then there's going to be a lot of weight put on that. So it would be a very interesting dynamic and a difficult dynamic for the new chair.
Do you expect him to stay?
I think that if the legal stuff is still going on, or if the Supreme Court should decide to that Lisa Cook can be fired, I think Powell would try to stay on. He's an institutionalist. He would do his best to protect the institution. Now, if Cook can be fired, he could be fired. So that leaves us, up in the air about whether he would stay on or not. But I think he's more inclined now to stay than maybe he would have been before.
Can we talk tariffs?
Please.
Okay. We
thought third time it's going to be the charm.
we thought maybe this morning we'd hear from the Supreme Court ruling on tariffs. The Supreme Court did not rule on it. The court, though, preparing to begin a 4-week recess, and under its usual procedures for releasing opinions, the next potential day for that decision could be February 20th. Yet, President Trump already threatening tariffs on European allies for those who don't go along with this idea of a Greenland grab. Get a little wonky for us with this. The tariffs that the president's threatening, would those fall under the same framework that these IEEPA tariffs are being tested in the Supreme Court? So if we had heard from the Supreme Court, the threats that he's making wouldn't hold as much water?
That we don't know, because there are a couple of other things he could do. He could claim. He's made the case that Greenland is a national security issue, and there is a section of trade law that allows the president to put on tariffs based on national security. That's how he put on the tariffs on China in the first administration, and also renewing them this time. There's also a short-term trade discrimination tariffs thing that would probably be their all-purpose short-term fix, where you can put on tariffs up to 15% for 150 days. And so you could immediately throw those on and then work out what other tariffs you want to do. So there's some avenues for him to do this. Again, it would be difficult to make the case that Greenland is a national security issue that demands tariffs, because you'd be putting the tariffs on Denmark, which is an ally of the United States.
And we have military agreements with
and
Denmark
we have military
already.
agreements, and Denmark has already said we can put all the bases we want in Greenland. So you would have a tough maybe case making that in court, but just look how long it's taken for all this to go through the courts.
Right.
And so this could last for quite some time.
We asked Bob Michael after the president, who I believe is still speaking at the White House. We continue to monitor, and I'm not necessarily seeing...
I see a couple headlines.
You want to go for it?
Yeah, I mean, the president said that he reiterated, we heard this from him last week, sanctuary cities won't receive money anymore. I think he made those comments in Detroit about a week ago. The president also saying that sanctuary cities, they can sue us, maybe they'll win. But that was, pretty much a half hour with no headlines between that and what we heard about a trade deficit.
All right, we're going to continue monitoring the president. I do want to point out that we do have stocks just off their lows of this session. What does that mean? For the S&P 500, we're down about 1.9%. On the S&P, down 134 points. Dow down 1.7%. NASDAQ 100 down 1.95%. So almost 2% decline. So just off our worst levels. And a quick check on the Treasury trade. As we've seen, yields certainly move up. And we've got a 10-year note with a yield of 4.28 right now. 2-year note with a yield of 3.58. I want to go, Mike. We're talking with our own Michael McKee, of course, covers international economics and policy. I'm just thinking about like what the impact will be, but I want to take a look back, because this is the 1 year since President Trump came into office. He's in the White House talking about all of his achievements, talking about his success. We put that question to Bob Michael, who said, well, you know, you look at the economy, you look at some different factors, things maybe not so bad. How would you, as an economist and someone who ties all this together, have his policies been successful for the United States?
Let me use the same language that Bob Michael used, objectively. Take a look at it. When you talk about growth,
which is what we like to do,
you have to look at compared to what, and the growth was as faster in Biden's last quarters. Mm-hmm. We also saw strong growth in the third quarter that was largely because of trade, because we didn't import stuff, which has the function of basically subtracting from GDP. So since we didn't import stuff, growth was stronger. Growth may be stronger in the fourth quarter, but there's a feeling it's going to be a little bit weaker. The one area he might have helped growth is with the tax cuts, because people may be getting higher tax refunds and they'll probably spend them. Depends on how much they get. But in terms of inflation, I mean, the Fed has brought inflation down, but it's stalled out. So we're not really making progress there. In terms of, and I told Bob I would have, we could have had a nice fight over the tariffs thing, because yes, there's tariffs revenue, but basically that's because he raised your taxes. And so you're paying more in taxes. So you want to say the president gets credit for sneakily raising your taxes and not having you complain about it, then yes. But at this point, probably the judgment is things weren't as bad as people thought they would be. So in that sense, it's not a disaster.
Well, especially the inflationary effects of tariffs weren't as bad as people thought they'd be.
Yeah, a lot's happened there, and it's hard to disentangle it all. But basically what happened is he put the tariffs on and he took the tariffs off. And then he slowly ramped up some tariffs here, some tariffs there.
Because we are paying more.
You are paying more
for
imported goods. And two studies out recently, two very respectable studies, say that the U.S. Taxpayers are paying 95 to 98% of the tariffs. It's not being imposed on foreigners. But the problem is that it took a long time to get the tariffs in place, because he kept pausing them, and then the tariffs were adjusted on a regular basis. And so the general feeling of economists and folks at the Fed is that we're probably going to see inflation rise over the next couple of months, because the tariff effects are now coming in. They may not be as strong as people thought. One reason being that a lot of stuff's coming in through Canada and Mexico, and with the USMCA, they don't get tariffed.
I'm tired already. It's only Tuesday, and it was a long weekend.
It's a four-day week.
Somebody said that this has been that 2026 has been the longest 10 years of their life.
It is so true.
We're 20 days into it, Mike. So.
Amen. We have you to walk us through it. Mike, thank you so much. Michael McKee, Bloomberg TV and Radio International Economics and Policy Correspondent, joining us right here in studio. When we come back, we're going to talk about the global corporate debt market, especially as we see some telling signs, perhaps. But we'll get into that in just a moment.
In the meantime, the S&P 500 down about 2%, just hovering around those session lows. Charlie Pellet in the Businessweek studio has the details. Hey, Charlie.
Hi, thank you very much, Tim. Right now it's 6,800 even, year to date. Looking there, yes, the year is young, but we are looking at a loss. We're in the negative now for both the S&P and NASDAQ. A lot of red on the screen today. Right to the numbers, all about geopolitics. S&P down 138, now at 68.01, a drop of 2%. Dow Industrials down 884, a decline there of 1.8%. 0.2%, while the Nasdaq Composite Index down 2.3%. The 10-year currently yielding 4.28%, with the 2-year 3.58%, the 30-year 4.91%. Spot gold at $47.63 the ounce, up $92, trading above $4,700, up 2% today. Yes, a record on gold. Silver also higher, $94.60 on silver, up by 0.2%. West Texas Intermediate crude up 1.5%, $60.34 a barrel, and Bitcoin down almost 4% now, 89,291. French President Emmanuel Macron is blasting President Trump's trade strategy, which he says is meant to subordinate the EU. The Danish pension fund Academica Pension is going to exit U.S. Treasuries. Also, the Canadian military has been modeling a hypothetical U.S. invasion, that according to the Toronto Globe and Mail. Earnings news, 3M's profit outlook fell narrowly short of Wall Street expectations. 3M shares are down by 6.85%. Coming up after the close of trading, Netflix down now by 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Carol Massar along with Tim Stenovec live here at Bloomberg headquarters in New York City on Bloomberg Businessweek Daily. Hey, one of the stories, and not stories, but reality in terms of the global trade, borrowers venturing back into Europe's marketplace for debt today, though some companies staying away amid the tensions with the U.S. over Greenland. And that's after we saw global bond sales having their biggest ever start to a year as borrowers of every stripe seized on investors' insatiable appetite for risk. U.S. alone, that first full week of the year was one of the busiest for U.S. corporate debt sales on record, and risk premiums we saw staying low even amid heavy issuance. But the amount of bonds teetering on the brink of junk surging last year, that's according to JPMorgan Chase. They put this out a little bit more than a week ago, at least, and we included it in our reporting. So we want to kind of dig a little bit deeper into this market.
It's time now for our weekly Women, Money, and Power, where we speak with some of the most influential women from across the business world. We've got Joanna Gallegos with us, co-founder of BondBloxx. It's the ETF issuer focused on fixed income, more than $7 billion in assets under management. We spent a lot of time in sort of the first 45 minutes of the program today talking about what's happening overseas and U.S. Treasury market reaction. I want to focus a little bit on corporate credit and the outlook in 2026. Carol mentioned some of the sort of the busyness that we've seen already this year, but what is the outlook on corporate credit right now?
Yeah, I think we would say it's the same red thread we've seen over the last 3 years in corporate credit, and that is the resiliency of American companies and the debt that they're issuing. Even all the way down into high yield, you're seeing, lower or average default rates. People can count on the fundamentals of these firms year over year. These companies have started, pre-pandemic with really good foundations in their fundamentals, and that's continued. So the resiliency of the economy, the strength, is actually the story when you see those tight spreads. What we focus on at BondBloxx is your ability to trade or your ability to access different points of income for risk across all the asset classes in fixed income.
Well, talk to us about flows in, out that you've seen maybe as you wrapped up the end of last year, and then what you've seen as we kicked off 2026 as we kid. Was it Mike who said that folks have been saying it's like already felt like a decade here in 2026? So give us a little comparison.
Yeah, I think 2025, more record years. In my space, in my industry, ETFs are an incredible tool for people to access fixed income markets. It just continues to grow.
But where did you see most of the money coming in
you're still
last
seeing
year?
And
then what's changing this year?
A ton of strength. It's sort of a familiar story. A ton of strength in shorter duration assets. People look for, the most attractive yield and risk combination they can. And shorter duration has been a huge category for ETFs, and it continues to be so. Really strong growth in corporates. I think your previous two commentators talked about how, towards the middle and the end of the year, people were still looking at the strength of corporate debt. In ETFs, it was the same story. And then we're seeing on our desk, we talk a lot to clients about public versus private debt and how to access that. So a lot of conversations, a lot of interest in how to complement existing bond portfolios with other sources of yield or looking for a way to enhance yield.
On the public side, the 10-year yield getting our attention, at least today, 429, where it is right now. You were shocked to see it that high.
Well, hitting 4.3%, right, on the 10-year. I was a little surprised. I mean, it could be 5%, and we have, but I was kind of surprised.
Yeah, the recent move higher that we've seen. Why has that been?
I think that, in all these bouts of volatility, again, as we've looked over the long term, we've seen the 10-year approach 5% a few times. And it just represents the concern and the look, and, hopefully structurally the yield curve is changing towards rates being higher on the long end and shorter on the short and lower on the short end.
Which makes more sense logically, but you kind of get in terms of the short-term volatility that we continue to see, whether it's White House strategy, that is certainly upending.
Yeah, I mean, that is embedded. There's going to be, the tariffs are now embedded in the outlook in 2026 for investors. Volatility is always on now. And in the equity markets, what we like to call people's attention to is that a year like last year, if you aren't looking at fixed income, aren't looking at bonds and how to add more income into your portfolios to offset volatility, like you're missing out on these huge cushions.
Which was I feel like it's been the talk for the last year or so, or a couple of years, right? Where you think about what you can get on a U.S. Treasury, right, in terms of yield and return, and lock it in. Like, why wouldn't you? Especially if you're thinking longer term. A lot of your offerings, obviously, are within the U.S. Treasury market. You guys do some emerging market, right?
Yep.
What kind of activity have you seen? Right now, I'm looking, I think, 5.2.
So emerging market as a category in
yield.
fixed income was the best performing category across fixed income last year. So a lot of interest in dollar denominated debt, and then also just getting non-U.S. exposure was a trade last year. So what we think is important across fixed income is just understanding how you position your bet or how you position the way you think about that. And one thing about emerging market debt is it's typically very, very long dated debt. So there's a implicit two things going on. There's a relationship to the U.S. dollar, and then there's also just the duration risk in there and interest rate risk. So what we try to do is update that space because people really do want to be shorter. And that's something that I think.
So it's active in terms of the change, in terms of composition?
No,
or?
It's an index fund, but it's just a shorter duration. And I think that appeals to people to think about, how do you think about a 40-year exposure? And should you be dialing that back in these markets? This is a simple 1 to 10 year exposure, and I think that's what's going on in fixed income markets as they relate to equity markets in your portfolio. Is now people really understand the maybe pain of interest rate risk and what can happen when rates zoom up, and what you're anticipating for this year if rates continue to go down. But we think that's going to be very moderate this year.
We're going to be speaking with Emily Griffeo, Bloomberg News cross-asset reporter, in just a few minutes, and she's written a lot about ETFs and how competitive the space is. I mean, it's just, I don't have to tell you or anyone watching or listening, there are so many ETFs out there. Do you plan to launch any new ETFs this year?
Yeah, we have some in registration.
Where's the white space? where are the areas where that haven't been covered?
Well, I think a big innovation from last year was private credit. And Emily's written a ton. Emily's written a ton on private credit.
I knew that's where you were going.
And the reason is because ETFs tend to touch places that you need more transparency in, you want to have access in, and liquidity. And so those are the spaces that people put time and effort in terms of innovation. And I don't think that that's done. I think that the important work in how you can access alternative yields, alternative returns, is important to ETF investors, because ETFs are used in big, broad swaths of wealth portfolios, and they need to be more precise. Markets are more precise. The modern markets are more precise, and so having an ability to add private credit has been the talk. She's written a lot about it. Is it private credit? Is it not private credit? Our private credit product, PCMM, was the first to give you access to middle market exposures and completely. So it's a pure approach, and that's what clients are really buzzing about when we're talking to them about what to do next.
Am I right in terms of assets? About 187 million?
187 million, yeah. And it's surprisingly that's the leader in the category in terms of adoption. And that's sort of, I think, the next frontier is improving people's exposure to that in their portfolios and improving their perception of what is in a private credit ETF.
All right, got to leave it there. Joanna, thank you so much. Joanna Gallegos, she is co-founder at BondBloxx. They've got about $7 billion in assets under management, joining us right here in our studio.
Hey, I'm just looking at the equity market right now. The S&P 500 down 1.99% in the S&P 500. Every single industry group is in the red right now. Consumer discretionary down more than 2.9%. Information technology down 2.6%. Financials 2.3%. Industrials, Carol, down 2%. Best performing sector, consumer staples. There's a little bit of green. Household and personal products.
Yeah, looking at the S&P 500, more than 409 names, so more than 400 down in the session, 94 to the upside. Having said that, it's not necessarily, it's broad-based in terms of selling, but it's, down about 2% now on those major averages, so just off our worst levels of the session. But again, definitely I don't know, can I go as far as saying a sell America today?
It's going to be a big theme of our 3 and 4 o'clock hours. So that's a major question we're going to be asking. That's the backdrop.
I feel like geopolitics certainly front and center in the position of the U.S. against the world. So something we're going to keep an eye on.